The truth is, sometimes we get comfortable with the ordinary, sitting inside the lines others have drawn for us, when there is an entire blank canvas of a world waiting for us to trust fall into solutions to questions not even asked yet, to rise, revise, and recognize that remarkable is not only possible, but it is necessary. It is the result of daring to imagine beyond this partition of parameters, always onwards, upwards, and forwards, towards the whys of ideas redefined, the what-ifs of partnerships, the how can we improve this. This is more than a common belief that in order to succeed, we must always see details 3 steps ahead. This is not about spotting market trends or hopping on bandwagons, because many others have been there, and quite frankly, so have we. But we are also about people. Shorooq, the right fit in the right place, like perfectly timed happenings matching skills with partners already found, where the sum of parts can create platforms only teamwork lets you reach. No, not you, us. Plural, collective. A home field advantage, expertise meeting the opportunity of what we did, are doing, and will do. Investing in holding open doors wide enough for impact to walk through. So we continue being the outlier, the deviation, the above and beyond expectation, the ones uncomfortable with being ordinary. Today is the day. Join Shorooq Partners.
Welcome everyone to our first and series, back to the series of venture debt in MENAP, where we weekly, every Tuesday at 3 p.m. GST, Shorooq Partners and IMM Invest Global go live on LinkedIn, Twitter, and YouTube, where we collectively work around venture debt, answer your questions, and get you up to speed to what to expect about venture debt. If you're watching this through our LinkedIn, Twitter, or YouTube, remember to follow, subscribe, and click that bell icon to get notified with all our news, events, and updates. This show is brought to you by Shorooq Partners, the leading tech investor in the Middle East, North Africa, and Pakistan. And I'm your host, Tariq Fouad, Head of Growth at Shorooq Partners, and I want to thank you all for tuning in from wherever you are. I would love to be joined today and welcome to our streaming today, Sean Jin, Director at IMM Invest Global, and obviously my colleague and the only one, Nathan Kwan, Senior Investment Professional at Shorooq Partners. Thank you both for joining me today.
Great to be here, Tariq.
Thank you.
Well, today we have a very important topic to discuss, and I think over the past few weeks, I would love to bring about a recap that we talked about what venture debt is all about, how it's quite new and nascent to the region, yet it has been out there for years and years in other ecosystems, and how Shorooq Partners have been, alongside IMM Invest Global, have been pioneering that space in the region. We also talked about, what is venture debt? What is its elements, the collaterals, the warrants, what term sheets look like, and what do founders expect from a venture debt fund? And I think we've established to a point is that now a founder is approached or has been have approached a venture debt fund. There is some sort of an excitement that is built on both sides. The venture debt fund now is looking deeper into that startup, and they will start a due diligence process. And the question becomes, what does this process look like? And how do a founder plan and prepare for that very important piece, right? Due diligence processes can be hectic, it can be long, it can be a nightmare, yet sometimes it can be a walk in the park. So how can we make sure that these guys can get a walk in the park experience when they're approaching a venture debt series? So I would love to maybe open up this first question to you, Sean. You've mentioned previously due diligence is a process, maybe just shed light on a high level what this process includes.
Sure, Tarek. Thank you for the setup. I'm sure some of you are familiar with a typical due diligence looks like for an equity investment. There are a lot of similarities between those that we conduct, compared to the equity due diligence process, and there are some pieces that sort of differentiate. So I'll just start from those that are similar. So, due diligence is a process where, investors get to know the company, assess the business attractiveness in terms of the macro trend, market, the business model, come up with the investment highlights, and then also assess some of the areas where business can be risky. And it's a process, of learning. And, I think for companies that are seeking investment from various investors, I think they must start with a sound business plan. So, in the previous session I mentioned, we try to focus on a company that has validated its business model and has a working, sort of unit economics that show scalability, the path for further growth. So the business, plan is something, that's just not just apply for investors. I think it's, a representation of, how management sees their business and how they plan their business, how they plan their growth. So I think it's a very useful sort of starting point. And then, alongside, I think it's important that you have a proper, historical financial analysis as well as the projections. So, it's important to tell a story, but in order for the story to be substantiated, I think it's important that the management has sound, grip over the key drivers of their businesses and how, top line, the sales numbers, the management expects to grow, as well as the cost structure that comes with it. So, so far, I mean, that's like a similarity with the equity investor. And the sort of the unique part from a debt investment point of view is the fact that, we have to look at the cash, component. So we'll look into a specific, capability from the company to be able to service the interest payments, because, there are quarterly cash interest that we expect from the company. And, we have to also be comfortable with, the value of the collateral. So, these are the, sort of downside protections that, that investors will ask for. And, as we have to, honor the fiduciary duty and be able to explain how we're getting those types of, protection measures.
I love that, Sean. So I think you've kind of touched upon the financial element here, and then that there's a good starting point is that you need to have a story. You need to, as a founder, make sure that you have a business plan, a solid business plan in place, and that the financial element or the main headline here is that can you pay back the collateral? Can you pay back the loan and the debt? And I think there's obviously that's a great starting point, and I bet there's a lot to go through here when it comes to the due diligence process. Nathan, what would you say, additional elements that usually a due diligence process would go through?
Right. So as Sean talked about kind of the standard framework that we have and the important things to touch upon, let me touch a little bit more on the specific aspects that are particular to venture debt and where a typical equity due diligence might not cover or only cover lightly, but which is very important for us as credit lenders, and we delve more into. So there are really four aspects that kind of fall under this category. So the first is, I would say, the past and current obligations that the company has had. And what I mean by obligations doesn't necessarily mean just the loans or borrowings that the company has taken on, but also what are kind of securities or guarantees that the company has provided. So normally in the course of business, even if it's not a direct financial transaction, you are likely to have a lease on the balance sheet. You could have liens or charges or mortgages that are provided as a day-to-day transaction and the normal course of business that you have. And it is important for us to understand all of these kind of obligations that exist. One, because we want to be able to make sure that we navigate our ways in such a way that it does not violate the previous obligations or contracts that you have. And two, when there are multiple obligations that the company is taking on, it is always a best practice to lay them all out in an intercreditor agreement to make sure that all these different dynamics are governed under a single unified framework. So unless we have something like that, down the road, it could become very complicated or messy when there are two kind of conflicting claims, or someone thought that they had a claim on one while the other didn't. So it is important to kind of lay all of these out from the get-go, make sure everyone is on the same page, and we help the company guide through that through our due diligence process. So that's the first one. The second is what we in the financial world typically like to call source and uses. And I'm sure you've heard about this from the equity side from time to time as well. But for the purpose of that, really, the sources and uses refer to, one, what is the source of the cash that you're going to be using to pay off the debt, to repay the debt when maturity comes? Is it going to be the profits of the business itself? Is it going to be future equity financings? Or is it going to be a refinancing? And refinancing meaning that you're going to take on an additional loan at hopefully a more attractive term to pay out the obligation that you have and then replace it with a different loan. So those are the three standard types of repaying a loan, and we want to understand and work with the company to devise what would be the best course of action for a particular company. The second source would be the source of a collateral, right? So what are the assets that are available to the company that could be used to underwrite the loan? So that could be physical assets, which would be the traditional asset-backed financing model, which could be proper PP&E is a traditional one. Inventory could be another one, but it doesn't have to, right? As lenders to startups and venture-backed companies, we tend to look at a more diverse array of securities than traditional banks do, which is what also makes us the right fit for the technology-based startups. So those could be your IPs. It could be the receivables you have from your vendors and suppliers. It could also be some other form. It could be a revenue from software, which would be a recurring based form. So we take a very creative and a flexible approach to this, but it is also important for us to understand what is out there that could be underlying the loan in order for us to provide the best structure. Uses, of course, is self-explanatory. We want to understand how the company plans on using the debt proceeds to further grow the company. Now, the third thing would be the organization of the company. And I think this is something, this is one of the key differences, and it's something very mundane and boring, so people tend to look over. In an equity DD, you'd normally just provide the investors with an org chart and you leave it at that. But because with that, there's a lot of different regulations that govern different jurisdictions and different countries. And even within different countries, for countries like the UAE, for example, there are multiple free zones between Abu Dhabi and Dubai, right? It's your IFZA, DMCC, DIFC, ADGM. So all of these jurisdictions have slightly different rules governing it, governing the companies incorporated there. So we take a very detailed look at where each company sits, what are the jurisdictions they are under, and then what are the laws and kind of regulations that govern the business of each of these corporate entities. And the final item we would say is the litigation. So has the company faced any lawsuits or litigation in the past? Of course, our hope is there is nothing there, but if there is something, we'd like to know about it sooner rather than later. So those I'd say the four key aspects that are specific and particular to venture debt.
Love that. And probably just want to make sure that whoever is, all those who are looking at us and tuning in for today's session, feel free to throw in your questions at the comment section below, right? So if you're watching on LinkedIn, YouTube, or Twitter, follow us, subscribe, hit that bell icon for you to get all the news and the updates from Shorooq Partners, but also make sure that you put your questions down there for Nathan and Sean to actually get back to you. And we'll try to answer all of them prior to closing today's session. If not, rest assured, we'll have more to come over the next few weeks, and we'll make sure that we cover them in through your direct messages or your comments. So thank you, Nathan, for this. And I think, you've kind of touched upon the litigation aspect you've touched upon, understanding where this company sits in terms of jurisdiction and how the different laws apply there. But obviously, you've also kind of digged a bit deeper into how do you kind of run, I would say, more of what you're trying to get out of the DD process, which I think is so critical. I don't think everybody necessarily is always aligned on what is the goal out of the DD process, right? And I think bringing about alignment right from the beginning is that, hey, listen, out of a venture debt fund, we want to make sure that we understand, the different collaterals that are there, what you guys own versus what you don't. And then obviously as founders, you want them to prepare for these answers, right? For these questions to make sure that at least the process is quite quick and fast and smooth. So Sean, out of your tremendous amount of years of experience in venture debt, in your I would say in your experience, how does venture debt due diligence process kind of change from one startup to another, from one vertical to another? Can you maybe bring about certain examples where at certain instances maybe typically you would look at this, but in some instances you can disregard it because it's not necessarily as important? Are there maybe certain sectors that you prefer to do a more thorough due diligence in versus others?
Great question, Tarek. I mean, we use the term venture debt, but it's essentially, I mean, each deal actually has a different risk profile and different kind of characteristics based upon which sector and what kind of business model that they have. So it's really hard to characterize one kind of common feature per se. But when we look at some of the deals, I think it's important that we assess where the business is currently standing in terms of its maturity level. Obviously, if the company has gone through multiple rounds of funding and has higher kind of valuation from stamp from equity investors, that obviously represents lower kind of risk level. But it's difficult to ask for competitive interest rates for those types of guys. So the kind of concerns and kind of due diligence points will be different for those types of late stage players versus those that just have gone through the first kind of institutional funding or Series A or even Series B. They still have much more unproven and yet promising projects in front of them. The key kind of due diligence points will be different for these types of early investors, right? And then aside from the maturity level, I think there's also an aspect of what kind of assets the company will require in terms of growing its business. It's easier for us to sort of invest in asset related businesses that is easy for us to sort of attach value to the new asset acquisitions that the company will be taking on versus those that have very promising scalability. If we are comfortable with proven kind of business models elsewhere in the global benchmarks, and if the company has lower kind of next round financing kind of risk, I think that's also helpful to sort of assess the level of risk that we will be assessing.
I love that. Appreciate that, Sean. You actually brought in very valid points here. And I think that is a great segue for my next few questions to you, Nathan. I would say, the process itself, I would say probably shed a bit of light here on how long have you seen this process usually take with startups? I mean, we've established that usually Series A and beyond are the typical, I would say, sizes that at least you'll kind of want to start looking at, right? Provided that they have the right, obviously, financial backing and performance that you're looking for. So give us a bit more, maybe, I would say, light here on how long does the process take? Usually, who's involved in that process? Is it, do you usually see only the venture debt fund and the startup, or are there third parties that come in to assess the assets there? And then, it is usually is that these costs, and if the lawyers are involved, are there certain, certain structure there to kind of cater to the costs involved here? Just kind of more elaboration on that point before we take in a lot of the questions that are pouring in.
Yeah, sounds great. So this is one of those questions where really the right answer is it really depends on the case. But as a rough benchmark, I'd say typically the due diligence process takes 2 months. Now, what could speed up the process is if the company already has a robust data room that they prepared either for a previous equity round or an upcoming equity round. A lot of the business-related and market-related questions, we ask the same questions and look for the same answers and look for the same details. So that could save a lot of time there. The other aspect is if the company has robust governance and compliance measures, because a lot of the things we look at as lenders do have to do with regulations and legal matters. If those are already kind of documented by the company in an easy to access way, it also does speed up the process. Now, what could kind of hinder the process or delay the process is if some of these, especially usually has to do with the legal side, right? Most startups who have done even one round of fundraising have their business fundamentals and have their business aspects down. But for questions like what kind of jurisdictions do you have, what kind of previous obligations or securities have been provided before, what kind of litigations has the company faced before. So these kind of questions, if you are not expecting it, it could kind of take a bit of a time to work through because it often needs the help of the lawyers to walk you through them. And that, I guess, kind of brings you to answer the second part of the question is what are the typical parties that will be involved? So in addition to the investors, of course, there will be an involvement by the lawyers, and we advise the startups to also kind of seek some counsel when it comes to matters that they're not particularly familiar with. Because we also want you guys to have the comfort that you get from your counsel and make sure that you understand what you're getting into. Also, we would normally have other investors joining us with venture debt, right? So meaning on the equity side. So normally these kind of rounds happen in parallel, or if not in a complete overlap, they would kind of come at the back of each other. So we always we don't want the company to do the same work twice. So we try to leverage the work that was already done before. We also ask the equity investors coming in to kind of share some of their insights to do the reference checks. So those are some ways that we could help speed up the process further.
Love that. Thank you so much, Nathan. And I want to thank both of you for being very open and transparent when it comes to the process here. We've received a good amount of questions here, and I would like to maybe start off with some of these. So we'll start off with the first question from Tariq Taji. Tariq is a friend of Shorooq Partners. Thank you so much, Tariq, for tuning in today. And the question is, does the collateral have to be equal, or maybe the current market value, to the amount of the debt? How liquid or transferable should it also be? So I would love for one of you guys to kind of take it over. Nathan, Sean, who would like to take that?
So I could actually take this one. Sean, please feel free to add color as you see fit. So here, the answer is the higher the value of the security, the better it is for both parties involved. And what I mean by that is because the further you can decrease the risk profile of the loan, the more attractive rates and more attractive economics that we can offer the company. So if you have an asset that could be offered as a collateral that has a relatively tangible value that could be evaluated by us, then it's good for the company, it's good for us. Now, of course, it is often not the case in the case of venture lending because the nature of the companies we lend to are early stage, they're technology-based, a lot of it is on software. And some of more of these intangible assets like IP, softwares that you have, contracts you have that have like future revenues coming in but haven't been booked in yet. These are harder to determine the value of. So these are the kind of things that we would work with you to see what would be there and what would be able to provide the value for us without hindering the business. And I think this is a key concept of security and collateral. We don't want to be hindering the business by taking something and restricting something that is instrumental to the operation of the company. The idea of security is actually to utilize something that is sitting on your balance sheet or sitting on the company's warehouse even, that isn't doing anything for the company right now. But by pledging it as a security or collateral, we are able to provide additional financing to you and unlock the value therein. So that is, I think, a key kind of a concept I want to emphasize. A lot of founders, I think, get a little apprehensive when they hear the word collateral or security because they think it's going to kind of hinder the business, it's going to hinder the operations. That is not the idea here. And securities and collaterals never kick in until it has to be, right? And those are very extreme cases we're thinking about the downside. So the right way to approach it is, what can we offer and unlock the value of something that we're not fully utilizing? And instead of having something that's just sitting on our balance sheet or as a license or an IP, get actual cash that can be used toward the business. Now, the second aspect I'd say is actually quite important. So it's not just the value of the security of the collateral, but how liquid it is and how easily exercisable it is. In some cases, I would go so far as to say that the ability to exercise it in a quick and an easy fashion is more important than the dollar value attached to it. And that is especially true in this region. As I'm sure some of you guys are aware, there's a lot of kind of regulations and red tapes that are governing different licenses and operations of the business. And if there is a way we could make the process effective, it will definitely decrease the risk profile of the loan and the collateral that you're offering, which in turn, of course, translates to better economics for the company.
Thank you so much, Nathan, for this. Tarek, that was an extremely good question. Thank you so much for asking this one. We've got another one from Savaraz. And my apologies if I'm pronouncing the name wrong there. But the question, Nathan, is that does the interest associated with venture debt accrues to be paid at maturity, similar to maybe impact investing sector? And what is the average rate of venture debt with or without the conversion?
So let's see, since there are three parts to it, let me try to walk through this one by one. There are two ways a venture debt interest could be structured. One is it is paid regularly, and we call that a cash coupon. So the period for that could be monthly, it could be quarterly, it could be biannual, but normally we wouldn't go beyond that. Or we could have something called a PIK, which is short for payment in kind. And in the case of a PIK interest, it does accrue to be paid at maturity. So you're not paying something regularly. You repay the interest when the principal of the loan is being repaid. Now, the calculus that the founders and the borrower should be making is usually if it's a PIK interest, it is going to be a higher dollar amount, right? So since you are paying at the end, you face less of a liquidity burden, but because it's a greater risk for the lender, the absolute dollar amount will be higher. If you pay it in the cash coupon, you pay it in a more regular fashion, more frequently, but you're able to unlock lower interest rates. Now, in terms of as a similarity to the impact investing sector, so yes, if it is a PIK, I'd say the structure there is similar, but usually it's rarely you'll see a venture debt where the interest is fully PIK. Usually there's a mix of both. So let's say you could have like a 5% cash coupon and a 5% PIK, or any sort of a blended. The typical rates here are, this is also one of those things where it really is by case basis. As a rough guideline, 12 to 15% is what you could look for if you're an early stage company. Of course, if you are larger and you have a more stable cash flow, that can be lowered. And I'm not sure what you mean by conversion rates, Safraz. So feel free to add a clarification here. But what I'm understanding is, will the loan be converted into equity? And the answer to that is no. So this is not like convertible notes. The loan is a pure on debt facility. Now, what you would typically see is, as part of the debt investment, the investors will get a warrant, which is a future option for future shares. So that part, because it's a specifically equity based instrument, that will become equity shares in the future. But the loan itself does not convert into equity. I hope that answers your question.
Love that. Thank you, Sarah Vaz, for the question here. One last question, Nathan, and please, if there are more questions out there, feel free to jot them down on the comment section below. But the next one is there a specific allocation generally accepted or common used for all venture debt money? I think here, from that question, and please feel free to kind of clarify, but maybe the question here is from a founder journey, Nathan, do you see startups allocating a certain round to venture debt? Maybe you can pick on some of the examples we've done before. I've seen some cases, and then probably that goes into how can a founder really structure venture debt versus equity to improve the overall performance of the startup.
Certainly. By the way, guys, I'm loving the outreach we have. It seems like we're reaching audience that even we didn't expect to be reaching for venture debt. So great to see the interest in this instrument in the region. Now, to go back to the specific question at hand. So what we would prefer to see is that the company has a specific use attached to the debt, so that they are able to, so that it shows that the founders have thought about why they want to be taking on this debt instrument and what kind of KPIs or goals that they want to be seeing. Now, what that use could be it really varies according to the company's sector and the business model. Typically, I'd say it is better if the venture debt goes to financing variable costs. So what I mean by that is if it's a specific fixed cost, like just paying salaries, or it's for buying equipment or setting up a new office, there are a number of different ways you could be kind of financing that. And in most cases, these kind of fixed costs go toward growing the business at its core, or expanding into a new vertical, or expanding into a new region. Those are strategic. Those are areas where strategic investors that come in through the equity could have a high value. And we want to encourage the founders to kind of explore those venues as well. Where we want to see venture debt being used is for recurring costs like working capital, or variable costs that go specifically toward growing and scaling a business that is already there. So instead of expanding into a new vertical, because that is a strategic investment, a strategic decision made by the company, but rather we want to see is there's a business model, or there's a product or a service that has already proven the product market fit. We know it's already there's a use case for it. And in order to help you grow that further and to hit you those KPIs that could get you to that next valuation in your following equity round, that's where we want to see the venture debt going. Now, of course, this is a general guideline. Depending on the company's use and depending on the specific situation the company is in, we're happy to kind of help structure which uses would be the best for the company. And that is one of the core kind of aspects of our job when we work with you as an investor. So this really is so I guess a lot of the questions that are being asked today, really the right answer, the correct answer is case by case. But I hope I was able to provide some rough guidelines to help you think through it. And of course, I know all of this could be very overwhelming. And when you approach us, we actually have a guideline that we send with you, so to walk you through it, to understand all these different aspects and nitty-gritties. So we make sure that everyone is on the same page and we can clarify things up.
Thank you so much, Nathan. I think you've tremendously done really well here. I think also follow-up was, yes, they meant right from capex, opex. Is there a blend there? What are the different things that they could potentially be raising venture debt with? And you hit it on the nail there. So well done. And I think one last question here. I would say, and probably we've touched upon this question before, what's the approximate loan interest range here that anybody should expect in venture debt? Thank you so much, Sheikh Ahmed, for sending the question. And obviously our following question is, and the tenor, right? So also what to expect there when it comes to maturity.
Mm-hmm. Let me just briefly touch on the CAPEX OPEX blend first, Tariq. So there's no set blend there. So, and I think what might be helpful is if I give a specific example. If the core business of the company is grown by acquiring more property, plant, or equipment, so you need like physical spaces, or you're a dark store or ghost kitchen, so you need these physical spaces, then the capex is something that is instrumental to growing the business and is a recurring expense, right? You could almost think of it as a working capital for kind of traditional business models. So in that case, we're more than happy to fund the capex through the debt. OPEX, I'm assuming when you say OPEX, you're talking about the fixed costs that go under the operating expenses. So those preferably would prefer to see something more, because the largest parts in the OPEX is usually the salaries that goes to the team members. And while that is also, since those are fixed costs that are not directly tied to scaling the business, although of course it tends to grow as your company becomes larger, we would prefer to see the expenses being tied more directly and tangibly to the actual growth and scaling of the business. Going down to
Sheikh Ahmed's question, yeah.
So the approximate range is, as I mentioned before, 12 to 15 is kind of where we start at, and that gets adjusted according to the risk profile and the stage and the size of the company. Tenure, 2 to 3 years is where we would normally start at. We would never go below 3 years, but we could go beyond 3 years. But also, more typical structure is we would structure for 3 years, and the end of the tenure, instead of asking you to repay the loan, we would simply refinance it, meaning we would extend the duration of the loan and then renegotiate the terms so it suits you better, and you are able to unlock that better rate that you've achieved by growing the company in the past 3 years you've had with the debt.
Love it. Thank you so much, Nathan. You're remarkable. Thank you so much, Sean, for being with us in another series of venture debt in MENAP, brought to you guys by Shorooq Partners. Remember, if you're a startup out there wanting to reach to us and you're building some really complex problems there, and you've got an amazing team that focuses on execution and fast execution, make sure that you approach us right through our website, Shorooq.com. That is Shorooq.com. Press that Get Funded button that you'll find on our homepage and all the other pages to get in touch with our investment team. We make sure that we answer you directly. Remember to also follow us at Shorooq Partners. That's all our social media channels: YouTube, LinkedIn, Twitter, and Instagram, for you to stay tuned to our news and our events and all the updates. From myself, Nathan, and all my colleagues at Shorooq Partners, we wish you all the very best and a great day.